Hello and welcome to another edition of For the Record. I'm Sean Murphy. Today we're going to learn how to buy your first house and lots of other financial stuff from our buddy Dean Harrington, CFO of Shamrock Financial. First time on the show. Welcome to the show.
Great to be here, Sean. Thanks for having me.
Tell us about that Shamrock Financial organization, that group. What's it all about?
Mortgage lending. Been doing it for a little over 25 years now, mainly in southern New England. Most of the states in New England, less Vermont and in Maine. In addition to a bunch of states around the eastern seaboard as well.
So let's go back in time a little bit. Perhaps you heard about some craziness that happened in the housing market, the lending markets. Maybe you heard, maybe you didn't.
Never heard of it, Sean. You have to
you can't comment on it, right?
Fill me in. Those dark years of, for us, we started seeing cracks in the middle of '07, some sort a little bit.
Isn't that when the housing market sort of, quote unquote?
Yeah, what happened is a lot of product dried up. That's how we would describe it, meaning a lot of loans that you could give people were no longer available. So that created an entire domino effect in the market. And by the time we reached the middle of '08, we really saw a lot of trouble. And of course, with the Wall Street problems with money, it all just became a disaster in our industry. It became a purging more than anything else from a competitor's standpoint. We lost a lot of competition. Unfortunately, the market went probably down 70%.
But when you say losing competition, you got rid of some of the bad eggs, right?
Yeah, it really purged them. A lot of mortgage companies began in 2001, 2002, 2003, in large part because mortgage lending was so easy. And you would find new companies opening all over the place. Well, we started in '89, and a lot of the companies that started back then knew that in that early part of the 2000s, this was not real. What was going on you're
talking about the Fannie Mae's of the world, that kind of stuff?
I'm talking about the independent mortgage lenders and a lot of the Alt-A and the non-conforming and the no money down and interest only. And
unrealistic, unattainable kind of things.
It really was. And when you open a company during that environment, you're not long for the road. And so we saw a lot of companies go out of business during that period. We were fortunate and blessed enough to have survived it. And it was a tough time, though.
What doesn't kill you only makes you stronger, kind of a thing, right?
Yeah, if that's the case, I'm really strong right now, brother. I'm really strong.
So, the housing market, that was the first to collapse, and that was sort of a domino effect that really affected the economy in general. But the housing market was the first sign of that happening, the good recession, right?
Yeah, and if you looked back even 24 months earlier, you started to see construction go down. Construction permits, different things to build in different areas of the country had really gone down. We take a look strongly at construction payroll. If you watch construction payroll, it's going to tell you where we're heading. And we all began to see real declines in construction, which of course, that's a backbone of the economy. It puts a lot of people to work, keeps Home Depot and Lowe's busy, it keeps traffic on the streets, it keeps everybody moving, it keeps the home improvement guy going, it keeps the builder going, it keeps city tax bases going. When you strip all of that away, it's pretty dramatic what happens after that.
So let's fast forward to today, to 2014. Where's the real estate market now? Are we out of it?
We're in a buyer's market.
Okay.
Yeah, we're out. Well, you know what? Let me retract that a little bit. We were in a buyer's market for a long period of time. It's starting to convert to a seller's market, meaning we have less inventory than potential buyers, which is good when you're selling. But it's a little bit demanding when you're trying to buy because you don't have as many options because there's just not as many houses on the market as you'd like to see. So what we try to tell people is that when you're out there buying right now, you've got to be really well equipped in terms of having a loan commitment, having your ducks in order, because they'll move on to the next person pretty quickly because a lot of houses are seeing multiple offers. And that's very different than it was 2, 3, 4, 5 years ago. Very different.
So for the novice out there, the whole time that the housing market was down during the recession, you could argue that that was a buyer's time because the people would be willing to sell for less. Now, in that same argument, mortgage companies, banks in general might be more leery about giving a loan, though, because of what was going on in the world.
Yeah, I could see both sides of that being somewhat true. I mean, just what I talked about in competition, having so many people go out of business and having, Fannie and Freddie really trying to redial their entire decision-making and what was going to happen with them. There was a lot of uncertainty on the lending side. At the same time, you had a lot of properties on the market, obviously, most of them through foreclosure in situations like that, which means you had a lot of distressed property. So it was a great buying opportunity in one sense, but in another sense, you were looking at houses that maybe not have been lived in or taken care of very well. People ditched out pretty fast. So I wouldn't have called it an ideal time to buy in '08. But
unless you wanted to do a fixer-upper, right?
Yeah, if you did, and that meant you need to have cash because lending was strict. The availability of funds was limited. So that wasn't the best buyer's market, I don't think. I think when you get into '09 and '10 and '11, it became a really, really nice time to buy. It's still a great time to buy. Homes are on sale. Prices are still reasonable compared to where they were 10 years ago. Interest rates are fabulous. So it's still a great buyer's market. We just don't have the inventory.
So there needs to be more building going on that you talked about?
Yeah, one of the things that we really have identified over the years is that there weren't enough homes being built during '07 to really last year.
Well, they stopped on purpose, right? Because of what happened.
Yeah, they didn't have any money, they didn't have any demand, and suddenly you don't have enough building when you have your population increasing. So, and you know, a lot of people doubled up and started going home, and kids started living at home. Well, as the economy begins to shift here a little bit in turn, you start to see those people go out and say, look, I want to buy, but there isn't as much inventory. So housing starts picked up last year for the first time in a long time. That building payroll and construction payroll began to go up a little bit. It's forecasting strongly that we're going to see a better real estate market going forward in 14 and 15. We're not going to see 2004 again. We're not going to see 2005.
Now, what does that mean, by the way? What aren't you going to see from that time?
We're not going to see someone buy a house for $200,000 and have it worth $300,000 18 months later.
Okay. Even if they put a little work into it?
No.
So those days are over. Was that
For now.
Was that unrealistic?
Yeah, absolutely.
Okay.
Absolutely. It was crazy.
Yeah.
It was the commoditization of homes, and that's not what they're meant for.
Right.
They're still meant for families, for communities, and for a nice, steady appreciation. Real estate doubles every 10 years since 1930. It way more than doubled in that period in too short a period. So we're just getting back to a normal market now.
You talked in the beginning about your Shamrock's sphere of influence, southern New England. Is there any difference depending on state, just in this area, whether it be Rhode Island, Connecticut, Massachusetts, those people that are watching this show today, anything different about those states?
I think there's a couple of big differences. Number one is unemployment. If you look at the unemployment rate, the better the employment rate, the more people working, the more real wages that are out there, and the better it is for someone selling a home, because obviously it's going to drive prices up a little bit. Where there's great unemployment, people don't have as much revenue, there's not as much income in the economy, and therefore prices are going to be down. So that's not good for anyone, really. So that shifts between Connecticut, Mass, and Rhode Island. Other than that, most of the guidelines are the same. The states individually are a little bit different from a legal standpoint, regulatory standpoint, but I don't think we want to spend any time talking about that. That's
You know, we just had a midterm election not too long before the taping of this show. After that, is there anything that's going to change as far as laws or anything like that?
The big thing we're all keeping our eye on is Fannie and Freddie on the national level. You know, one side of the aisle feels one way about Fannie and Freddie. The other side may feel a little differently. But ultimately, I don't see either of those two going away in the short term. And so I don't think there's a great difference in what's happened in terms of housing. There is a lot of discussion. You know, back in the middle part of the 2000s, we got in trouble a little bit by lending to people that weren't prepared and weren't ready and didn't qualify. There's a movement afoot that we're starting to look at that again, not us, but Washington. Are we lending to enough people that don't have substantial incomes? Are we lending enough to the people in the bottom 20% of the income pools in this country? Are we being discriminatory in those areas? So there is some battle back and forth on where that's going to go. Since 95% of lending right now is through government-sponsored or insured programs, we all have to take the lead on where they go with that.
You know, you mentioned, you know, are we discriminating by not going to a certain lower level, but isn't it conducive to grant loans and sell to someone who has the ability to be able to pay the mortgage back, pay the loan back? I mean, it's like
come on, stop talking crazy.
Yeah, I was warned, by the way, that if I asked you anything political, that there'd be a rant on set, right? Because I mean, you feel strongly about it.
Yeah, I do. I think we really overdialed. I think we really got crazy in 2001, 2002, 4, 5, and 6, believing that we could turn lending into anybody. I call it the three horsemen. You know, for the longest time when I grew up as a guy doing loans, you had to have good credit, good capacity, which means income, and good collateral, meaning the property had to be a good property. And we could bend a little bit. Like, for example, if someone came to you and said, look, I have an underground economy in my job. I'm a construction guy, I'm a bartender, I'm a hairdresser. I don't show all my income. But I've got 30% to put down on a home. That loan got made for a long, long time. It just got made at a 8% higher in interest rate. By the same context, if you came in with someone that said, look, I don't pay all my bills on time. I'm a little sloppy with my car payment, a little sloppy with this, but I've got 30% to put down and I make a lot of money and I got plenty of money in the bank. Made that guy 1% higher in interest rate, 2% higher in interest rate. We threw all that out the window. We said, look, we'll make every guy that doesn't pay on time, every guy that doesn't have all his income, we'll do it with no skin in the game. He doesn't put any money down. Disaster.
Yeah.
Disaster.
I mean, it's going to collapse, right?
You don't have any skin in the game. You've got no equity. Then values start going down. You're out.
So you mentioned there, because I want to get into kind of like the nuts and bolts of it. One of the things you mentioned there is I can put 30% down. If someone's going to buy a house, one of the questions that they're going to need to know is how much down. So how much down in this day and age?
As little as zero, and as much as you want to. Now, the 0% programs, generally a USDA and VA loan. We're taping this today on Veterans Day,
right.
So congratulations to all the veterans, and thank you for everything that they do. They mean so much to us in this country. The VA programs are no money down, and then you can get all the way up to 20 and 30% down where you don't have any mortgage insurance, where you're in a pretty safe valley in terms of interest rate. So there are still no money down loans out there. A lot of loans are done at 3.5 to 5% down. My school of thought is you want to put as much money down as you can to be able to stay out of the mortgage insurance and lifting the payment, but not so much that you clean out your savings to a point where you can't prepare for a rainy day. And I think that's a big thing, Sean. I think when I talk to people about buying a home, if they can put 5% or 7%, that's the difference, I say keep the 2% in the bank.
Right. Earn some interest on it, use that as a
Interest
rainy
rates are
day
low.
fund.
Yeah, just hang in there. And so we try to do, and I think a lot of good mortgage lenders try to do, is you try to really become a financial planner working in mortgages. We want to give someone a mortgage for a house and then keep them in the house. Novel concept, but one that a lot of us didn't think about, a lot of companies didn't think about 10 years ago.
Now, a novice person, maybe a first-time buyer or someone that just doesn't understand, might not even realize things like closing costs and, escrows, things like that, things that aren't necessarily what they see as the cost of the house, but it's those extra things that add on.
Of course.
Talk about that a little bit.
You've got some flexibility there. You can get into loans where sellers will give you the closing costs. You can get into loans where you can roll the closing costs into the loan amount. Most of your closing costs are going to be not really true closing costs, it's going to be the down payment. If you've got the down payment, the other stuff that comes up, your title insurance, your title searches, your appraisal fees, your documentation fees, your transfer fees are going to be pretty light.
That's a lot of fees, though.
It
sounds like a lot.
We are in a fee-driven society, as we all know. The death by a million fees, it doesn't get too bad. And a lot of them can be handled by seller concessions, or you can come up with them out of your own pocket, or they can be rolled in as part of an interest rate change.
So now, if someone's ready, what do they do? It seems like about 10 people that are real estate agents. Mm-hmm. So if that's your first move, how do you go about finding the right one when you decided, I'm going to buy a house?
All right, Sean, I'm going to answer that question as though I heard two questions there.
Okay.
I'm going to answer as though I heard how do you pick a real estate agent and how do you pick a mortgage lender or a mortgage loan officer, because it's the same thing. And I'm really a stickler on this, on how it goes. If you are going to look for a real estate agent, the first thing I want to do is I want to interview them. I want to treat it like a job application because they are going to work for me. I am going to pay them, and they're going to get paid by the sale of the property. So they are someone that I want to interview. The very first question I want to ask is, tell me about the last transaction that you did. So let's say you're talking to a real estate agent, and I say, hey, Mary, tell me about the last transaction you did. And she said, well, it was a single family in Stonington. It sold for $230, and they were really happy. I'm going to run. I'm going to run. Here's what I want to hear. Mary and Mark Johnson, mid-30s. He works at EB. She works for the state. They bought a $280,000 ranch. Needed a little bit of work, but we got the seller to kick in some funds for that. They got to a 4.5% interest rate with no money down. You get my point.
So you're really getting into more specifics of it, really detailed.
If they don't give you detail in that question, do you think they're going to give you detail when they're dealing with you?
Right, yeah.
Not a chance.
That's a good place for us to pause and take a break. Dean, why don't you give out the website for people to go and learn more?
ShamrockFinancial.com. We're also on Facebook at Facebook.com/Shamrock Financial. and pretty easy to find.
All right. Let's take a break and come back. Dean Harrington's the CFO for Shamrock Financial. We will take a break. I'm Sean Murphy. This is For the Record. Stay with us. Welcome back to For the Record. I'm Sean Murphy. My guest today is Dean Harrington of the Shamrock Financial Group Organization.com. I've given him a promotion, by the way. He's now the CEO. So congratulations.
I don't know. Can I turn that down?
You want it? You probably want to stay the CFO.
No,
but
I don't want to stay the CFO because that's
a hard job, isn't it?
Way smarter people than me. I'm not kidding.
They're dealing with the money, right?
Yeah, they got.
Right before we went to the break, you mentioned the website. What's on the website for people to go and see?
You know, one of the things that we try to do is we believe in educate and motivate. I think people buy from you or go to business for you because you know the most, not because you have the best this, this, and this. I think we can all know that when we buy a television, we buy anything, we want to go buy something from someone that knows the most. So what we try to do is educate. So we've got a video library, a webinar library that will teach people anything from how to buy a home to handling any situation with selling their own home. We try to educate real estate professionals because they are our partners as well. As in addition to first-time home buyers, step-up home buyers, contractors, anything that you can imagine. So we've got a lot of stuff there. We do 2 blogs a week, which is a lot of writing on topics that are, you know, obviously seasonally driven and economically driven and topically driven. So there's a lot of good content there. We try to make it user-friendly. It's not a billboard for Shamrock Financial. That's not what we want to do.
You want to learn regardless.
Yeah, you do. That's how people go look up your company. That's how they find you on Google. It's really the right way to do it. Educate and motivate is a DNA with us.
And then you have the links to social media so people can go network about it, and that, because that's really where they are, is on the Facebook and
absolutely.
Twitter.
We do Twitter as well. We really have a lot of fun with our Facebook because we want people to know that we have fun at what we're doing. We care about communities. We're involved in the community. So we're easy to find, and I hope it's a useful tool.
You're the perfect guy to ask this question from your point of view, because we talked about, you know, the housing market crash and then the recession in general. From your point of view, what you're doing, are we out of the recession? Or as my director likes to joke around, because I asked the question, do you see a light at the end of the tunnel? Is the light right there? Are we out of it?
Well, to be technical about being out of the recession, yes, because we've had, you know, obviously quarters of increase in gross domestic product, but I don't think until employment is fully where it needs to be that we can make that claim. I mean, I'd love to tell you otherwise, Sean, but I think until we can see employment at its fullest, and I know the unemployment rate has gone down, but we know that that's a little bit of a misleading figure because a lot of people working part-time, a lot of people
underemployed,
underemployed, and people out of the market. So I think until those housing starts really get booming, until capital begins to get freed up from banks and people stop putting money back on the street, I think we're still in a little bit of a fog.
It seems like the employers are hesitant. They want to rehire, but it's almost like they're waiting for another shoe to drop maybe, or they're not quite sure. They don't want the same thing to happen again where they have to let people go like crazy.
Absolutely. You know, I'll talk a little bit about my experience in this. We have a little bit more than 70 employees, and nothing hurts me more than to cut back a staff. I can tell you that from the honest to goodness truth. We run a faith-based, family-based company. We're together every single day, and I don't want to reduce staff. It crushes me to do it, personally and professionally. But when you look at things like the health insurance changes that are going on, and Obamacare, and the different challenges that we all have in just figuring that out,
right.
You get a little apprehensive about adding staff, about the hours that they're going to work. So there's a lot of uncertainty with that. We have a new gorilla in our industry called the Consumer Finance Protection Bureau, the CFPB. Compliments in part from a senator from this state a few years back.
There we go. We're getting into the politics now.
I'll stay away from that.
He's getting mad.
No, I'm actually.
Okay.
I'm reconciled to it.
Okay.
Because
you've accepted it.
You know what? Interestingly enough, it creates a tremendous barrier of entry into the mortgage lending world for competitors. So I have to look at it pragmatically to say that it's given us a great advantage in becoming the #1 mortgage lender in Rhode Island, because it's not everybody can open up and compete now.
Right.
So they've done me a favor in one way. But until all of the uncertainty shakes out with the CFPB and what their guidelines are going to be, and what their demands are going to be on us for net worth and for everything else and all of the other disclosure rules and laws that we follow, I think that we're in still a little bit of a time of uncertainty.
Yeah.
So I wouldn't say that we're out of it. But if I'm looking at it from a consumer standpoint, I'm going to tell you right now that this is the time to buy a house. It's funny. I always like to talk about this if I can go on a tangent, just for a brief moment.
Go on a tangent.
In 2003, 4, and 5, we read in the media that homes are now too expensive for the average consumer and that they've outpriced the average person. The average person can't buy a house. Isn't it interesting in the last 5 years we've heard that they're too cheap and they're falling down in price and it's a bad value because you won't get your money back?
Right. That would be a good buyer's market, though.
It's a great buyer's market. A great buyer's market. Guidelines are strict. No stricter than they were in the 90s, no stricter than they were in the 80s. It's just you're going to have the enforcement of those guidelines is real.
You know, one of the things that happens in a recession, and this is an unfortunate byproduct, are things like short sales and foreclosures. Maybe talk about that a little bit, and maybe sort of give definitions if somebody doesn't know what a short sale is, and you know what causes it.
Great question, by the way. Short sales are if you want to sell your home and you owe more money than the prevailing market rate the market will bear. So say you owe $300,000, but you know your house is only worth $260,000.
Is it like being upside down on a car payment?
Exactly
basically?
what it is.
Yeah.
So what happens is you're standing there thinking you have no way to get out of the home. You're increasingly having difficulty making the payment, but you're someone that wants to keep your credit going and you don't want to screw it up and you really want to stay on top of things. What you would do is get in touch with the lender holding the note and say, look, it's not going to yield $300,000. It's going to yield $250,000 or $260,000. Will you work with me on a reduced amount of money to repay back this loan? That process used to be gruesome, really bad. But most investors and lenders have realized that they've got to play a little closer ball. And frankly, our industry has gotten better at negotiating those and dealing with those. So that's a short sale where you would petition the lender to accept a lesser price.
And it still protects your credit rating, right?
It does. You have some restrictions that are coming back into the purchase market for a
Okay.
few years. But in this country, you cannot pursue for a deficiency balance. You can in other countries. You can't in the United States. So you're pretty clean. It's a great way to go. If someone's really struggling and their house has become too much of their life and they're living for their home and their mortgage because they're upside down, my heart goes out to those people. There's no reason to do that. We're not on this earth long enough to have a home dictate that kind of tragedy in our existence and put that much stress on us. They should reach out to their lender and say, what would you take? Will you take a reduction? Get a real estate professional involved who's done a lot of short sales. Foreclosures are straight out. I haven't paid the loan in 8 months. I may or may not have equity. The bank is foreclosing. They're going to put an auctioneer on my lawn and they're going to throw me out and take it. That's what a foreclosure is.
That's pretty cut and dry, basically.
Yes.
Yeah. How important, you know, you hear about this and you know it's important, your credit rating, but in terms of buying a house, obviously it's right up there with the important things that you need to have, good one, good rating.
Yeah, it's back to what it should have been all along. You know, of the 3 horsemen that I spoke about earlier, credit really is the most important thing because you can hide a lot of income. Some people do, you know, can hide a lot of income, can have a lot of cash in their business. A lot of people can be given gifts of down payments and different ways to handle the collateral. But your credit and how you handle your credit is really, we call it the 3 C's. And the C isn't credit, it's character. Yeah. Think about that for a second. So you got to be 620 or above generally. You can do some at below 620, some FHA loans. What we'll do if you come to us, and a lot of mortgage lenders will do this, is they'll look at your credit score and say, okay, you're not there yet, but here's what has to happen. Can we make the changes? Can we battle a couple of these creditors and say, look, this shouldn't be here? If not, we like to say, if not now, when? And begin a path to buy process with you where you come in and say, hey, I'm at 610 right now. We do some cleanup, you get to 620, but it's really not going to get you the best program. We need to get you to 640 or 660. We say, here's how we'll get you there. It'll take about 6 months to a year. Let's build a plan.
Of just basically solid payments, basically, right?
Yeah, a lot of things like that. Some things drifting off the back of the credit bureau, getting older, some debt that maybe you have too much debt for the amount of credit limit you have, things of that nature.
Are people doing themselves a disservice if they don't pay as close attention to their credit reports as possible?
Let's think about it. You watch what you eat and you know what you ate every day.
I don't,
you know,
but I'm sure you do, yeah.
Not every day. You know how much gas you have in your car probably. You know if you need gas or not when you're going to go out there. You know if your kids and your pets have eaten or what's going on or do they have to be in school today. Yeah, you should pay attention to it. It's really important. You should check it routinely, if not for theft reasons and identity issues, to say, hey, that's not right. This isn't correct. or to say, hey, how did I go down? You know, in my role, my credit is checked every 90 days by just about every state agency around because
because of what you do.
Yeah, because of what I do. And it's funny, I don't pull the credit bureau. Some of my officers come in and say, hey, what are you doing with this?
Oh, really? They'll point it out to you?
Yeah, it's not necessarily I can't have any credit issues or I'm going to be out of business. But it'll say, hey, did you really do that with your car payment last month? Yeah, I did. I switched cars and did something else. So yeah, we stay on it.
Yeah.
And we're in the industry.
Yeah, that's very true.
The other misnomer I want to
misconception?
Yeah, real misconception is I can't have my credit pulled a lot or it's going to kill my credit score.
Good, that's a great one, yeah.
Not really.
No?
Not really. Not to the point where I'm not going to look at my credit score for 6 months. Now, if you have a bunch of credit card companies pulling your credit bureau, that might ding you a little bit, but if you're shopping for a mortgage and you have it pulled 2 or 3 times, I think you should have it pulled once.
Right. Yeah.
But that's a little bit misleading.
You know, we are out of time. I've been mesmerized by this conversation. That time flew. We're out of time. Have you give the website out one more time?
It's time for the Sean and Dean show.
Yeah, we're going to have it. We should extend it. We'll go on the radio, too, and that should be a good time.
We'll do a bandstand.
The website has lots of stuff on it.
ShamrockFinancial.com.
And any questions, go on the website or call you?
Yeah, there's every tool you can use there. If you're a real estate professional, our favorite people out there, go on the site. If you're someone looking to buy a home, go on the site.
If you want to talk sports or politics with Dean.
Sports in particular.
Yeah.
Let's go.
We had stuff off the air.
Or mistakes. I'm really good at talking about mistakes I've made.
Mistakes?
Yeah, that's going to take a while. That's going to take a while.
Like 2 shows, so
Yeah,
we'll get into that. Dean Harrington, CEO of Shamrock Financial. Thanks for being on the show today.
Thanks, Sean.
All
This was fun.
That is our show for today. You can see the show and many others on our YouTube sites. I'm Sean Murphy. This is For the Record. We will see you next time.